SmallCapPower's Ask the Analyst. Today's episode, investing in mining stocks.
In your opinion, what makes a mining company successful?
There are a few fundamental factors that need to be there for any mining company to be successful. You need to have a deposit. That's number one. If you don't have a good deposit, you really don't have anything. From there, you can look at other factors like the management. Are they capable and have the required skills to mine that deposit? From there, you can look at if it's the right time to be in the market for that metal. There's lots of times when it's not economical to mine a specific element or mineral, and you need to move on to other companies. There are lots of bad times to buy good companies after all.
How do you know if a deposit is economic?
There are a few factors that go into this, and all of these are found in the feasibility study, which a bank uses to fund a project. But initially, you want to look at the location. If it's in the middle of a jungle, or compared to being in a grassland somewhere, it's a lot easier. I guess a good rule of thumb is if you don't want to live there, you probably don't want to build a mine. From there, you want to look at the geology. The main way we do this is through the drill results. Ideally, you want a large, high-grade deposit. Most of these have already been mined, so you're going to get one or the other these days. Both can be economical, but it takes a lot more money, a lot more cost, and a lot more time to mine a low-grade deposit.
As an analyst, what specific metrics do you look for?
So there are a number of metrics that you can look at, but I guess the two I'll highlight today are the strip ratio and the net present value. The strip ratio is how much ore you need to move to get at the mineral you're after. The higher this ratio, the more rock you need to move, and the lower the economics of this deposit. It's actually what ultimately constrains the depth and the size of the mine. The other metric that is widely quoted and definitely an important one is the net asset value. It's the actual value of the deposit in monetary terms. You don't look at it. You look at it as you look at the deposit itself without taking into account the capital structure of the company. You first want to see the size of the resource, how long it will take to produce that, and the cost of the production. You then take this number and you discount it back to the present to figure out what the mine is actually worth today. You use a discount rate in this process, which is a way of determining the cost of money in the future compared to money today. This number can be a little bit manipulated by different people, so you want to look at what that discount rate is. If it's high, it's a more conservative number. You also can look at things like if it's after tax or before tax, or the actual costs and assumptions that go into the inputs.
What does it take for a junior mine to go from initial discovery to production?
So the phases of any exploration or in any company, that any resource company, are the same. You first need to explore for whatever you're looking for. This will answer some basic questions like what is it you're looking for, where is it, and how large it is. This is the most risky part of the process and where most companies don't usually make it past. From there, you want to go into a planning phase where you figure out how you're going to actually develop this resource that you found. From there, you go into construction where you actually build the mine. This is the most capital intensive, both in terms of money and labor. It takes within usually 2 to 3 years. From there, you actually get into the production. Here is where you actually mine the resource that you found. It can take anywhere from 1 to 100 years, depending on what the resource is and its size. And then after that, you need to close the mine. So you want to bring it back to its initial state before you started mining.
How has mining changed over the years?
It hasn't actually changed all that much in the last 100 years. The same steps that you go through to mine a resource have been basically the same in the last 100 years. What has changed is technology. It's allowed you to get at different resources and lower grade resources than you could in the past. You now can mine much larger resources at a lower grade than you could in the past. The average grade of most mines now on the gold side have dropped from maybe 2 grams per ton 15 years ago to about 1. From there, also, the other major change is in regulation. It now is a lot tougher to bring a mine into production due to regulatory and environmental issues.
As an analyst, what are some warning signs that we should look for before we invest?
So I'd recommend that anybody looking to invest in this sector start off on the company's website. You want to look at a number of basic factors to see, firstly, is it a really promotional website? If it is, it probably is a promotional company, and they're not really focused on building value long term. From there, you can look at different factors. If the management has moved from company to company, has once been a gold company and now is a uranium company, they're probably not good at either. Also, on the deposit side, if it's a deposit that's been in a number of different hands over time, it's probably not good now since it wasn't good before. And another good factor to look at is if the management has their own skin in the game. If they're invested in a company, then they probably want to make this work.
Great. Well, thank you very much for taking the time with us today.
Looking for more expert investing advice? You should check out the Experts and Analysts page on SmallCapPower.com. And while you're there, be sure to check the Experts and Analysts Top 20 Picks. It's under the Premium Research tab. Happy investing from your friends at SmallCapPower.